Okay, so I'm going to go through the lend-a-hand statement of cash flows and then reconciling the book to tax net income and figuring out the tax provision. So, real quick, this is going to be recorded for me to prepare for the final as well as for you if you want to review this and you get confused about something. I'm going to fly through the cash flow because there's a solution posted. Um, but yeah, with the statement of cash flows, indirect method, you start with net income. It's given to you, 19,075, and then deal with all of the changes in assets and liabilities. So accounts receivable goes up by 9,000, so that's an outflow kind of 9,000. You didn't get that cash, but you'd recorded that you did in net income. Accounts payable goes up 1,000, so that's an inflow of 1,000. Accrued payables goes up 1,000, so that's an inflow of 1,000. Pension goes down by 3,000, so that's an outflow of 3,000. And if you wanted to do the T account, you had recorded a credit balance on liabilities for pensions of 5,000 for like last year, and you now record 2,000, so you know it goes down by 3,000, but you also have a pension cost of 5,000. So starting balance credit of 5,000, and then you also credit 5,000 to record the expense, and then your ending balance is 2,000. So the other side, the debit side, had to be 8,000, which is the amount that you had paid out. You decreased it by 8, and you paid out cash of 8. So the reason that the cash outflow in the statement of cash flows is only 3,000 is because you already recorded the 5,000 in the income statement. So you just need to add 3 to it to make it a total outflow of 8. But again, the shortcut is just using the balance sheet account from 5 to 2. Lawsuit, you'd recorded that as a liability, and now you had to pay it. So you'd already expensed it before, therefore it didn't show up in your income statement, and because you paid 25,000, you have to record an outflow of 25,000. Taxes payable goes down by 655, so you record an outflow of 655. The DTA goes up 9220, so you record that as an outflow because it's an asset. Dividends, this is from, well, we'll do stock compensation first. Stock compensation, you increase by 30,000 because you had recorded that expense and it didn't actually happen. You didn't get the cash for it, and it's a financing activity anyway, so it wouldn't show up in the operating, so you have to back that out, 30,000 inflow. And then you deal with the investment for, what is it, need a hand or something like that. So first you say we'd recorded a loss of 2,100. That's the $7,000 loss that they had times our 30% interest in that sub. So you had recorded in the income statement a $2,100 loss. That was not a cash transaction, so you add that back. And the dividends, you never recorded in the income statement, but you got cash for them. So you record an inflow, dividends you receive is operating, so an inflow of 900. And then depreciation is 2,000. You know that because of the change in net equipment in the asset side. So that's the operations part of the statement of cash flows. And again, I just breezed through that, didn't really show you how, just told you how. But if you needed that help when you're looking at the solution, preparing for the final or something, you have the solution in front of you. That's kind of walking through the logic. And then the financing section, you did receive cash, $3,000 for the stock options. So you record an inflow there of 3,000. And the dividends you paid, you know that dividends paid is 4,200 because your net income and then the change in retained earnings, you do the math there and you get 4,200 dividends paid. So that's an outflow in the financing section. Then we go to the investing section, and that's only one thing. You paid $4,000 for the need a hand investment, so you have an outflow of 4,000 there. That all balances out. That's great. Now let's go to reconciling book and tax income. So when you do that, the first thing it says is, well, you start with net income before tax. So you have 19,075 as the net income plus the tax expense of 13,145 minus the tax benefit, the deferred tax benefit that you had of 9,220. So that gives you right here. Now we're looking at the Excel thing that I have. Now that gives you the 23,000. So from there, you look at depreciation, and it says that depreciation or the tax basis was 17,000 in 2002 and 20,000 in 2001. So your difference there, you had a DTA for Where is it? Let's see. You had, oh, sorry, a DTL. That's what it is. You had a DTL of 420 from last year. Why? Well, you had a $2,000 temporary difference. And with that $2,000, if you multiply it by the 21%, you get 420. So that's your deferred tax liability. You're going to have to pay taxes on that later. It's a taxable temporary difference of 2,000. Once you apply the tax rate, you get a DTL of 420. So that's how you begin. And then if you look at the change this year, you see that depreciation was 1,000 more for tax because it started at 20 and went down to 17, and on book it started at 22 and went down to 20. So book had 2,000, tax had 3,000. So you take off right here this $1,000 for depreciation on the equipment. That's a temporary difference. You're reducing you're adding to the DTL $1,000 worth. Once you multiply it by the tax rate here, you get 21 or 210. So 420 plus 210 gives you a net DTL here of 630, and that'll come in later. Then you deal with the pension. And with the pension, you say pension expenses are deductible when paid. Well, how much did you pay? Well, you paid 8,000. You'd already recorded the 5,000 in the income statement. So you have to decrease it another 3,000. And that's why you have that little difference that in book you recorded 5, but in tax, because you paid 8, you record 8. You already recorded 5, so you only have that net of 3 to do. And that you'd think of it as creating something, but you already had a DTA recorded for the stock compensation. How do you know that? Well, we'll get to that in just a little bit. But just know now that that is your difference, the 3,000. Stock compensation, what's the difference? Well, you are only allowed to deduct it when it's paid. Especially with the whatever the tax deduction is 2,000. So you gave them a compensation of 2,000. You can see that on the journal entry, the cash of 3,000 and PIK of 2,000, and then the common stock credit of 5,000. 2,000 is what you're allowed to deduct. You tried to deduct 30,000 in book, but tax only lets you do 2, so you have to add back 28,000. Meals, you can only do half, so you see that was the cost. You have to add back half. That's a permanent difference. Then here we get to the legal liability. You had previously recorded it in your book last year, and now you paid it for tax. Tax only lets you take it when it's paid. So you end up paying 25,000, and you can deduct that in tax now because you've recorded it, because you paid it. Then you deal with the sub, and this is the one that's a little bit confusing that Sister Larson said most people forgot. Dividends, you didn't record anywhere in your income statement, but you are taxed on them. So you have to say, well, I was paid $900 in dividends. Boom. The loss was not a cash transaction, and the tax code doesn't care about the loss or the gain for that matter. So need-a-hand loss, you have to add back the 2,100. You deducted it in your income statement, but you can't do that for tax. You have to add back the 2,100. And both of those are indeed temporary differences because your basis in the tax is 4,000. That's what you paid for it. Your basis now in the financial books, you paid 4,000, so you had 4,000. Then you'd taken off the 2,100, and then you'd also decreased it by the dividends that you got of 900. So that decreased it by 3,000. Your book basis is 1,000. Your tax basis is 4,000. If you sold, you would recognize in books the $3,000, and that's where you would unwind that temporary difference. So that's how it's a temporary and not a permanent difference. Then the dividends received deduction. That one is a permanent difference. You never get that back. And you get to take the dividends that you had of 900 times 65%. That's what you get to deduct because you have between 20 and 80% of the business interest. Interest being ownership in that business. So you deduct that, and that's a permanent difference. This gives you the taxable income of $30,045. Multiply it by the tax rate, and that gives you the amount of tax, and this is your after-tax income.